Clearing used to be much less efficient. In the early 1970s, the backlog of records and trades got so bad that the stock exchanges closed on Wednesdays to give harried back offices time to catch up. Messengers had to hustle around Wall Street with bags of paper stock certificates and checks. Can you imagine how tough it was to keep up as volume increased? The risk of losing stuff to theft, fraud, or simple error was huge too. Things got much better after the Depository Trust Company got into the act in 1973. The DTC, which later became a subsidiary of the Depository Trust and Clearing Corporation, combines two brilliant ideas for handling this massive record-keeping task. The first idea is immobilization. Can you think of a good reason why paper stock certificates representing ownership have to move physically from one place to another? I can't. They aren't like a present that needs to be shipped to a toddler on her birthday so that she can play with it. Stock certificates are just proof of ownership. As long as we agree on a reputable organization to store the certificates for us, all we need to do is change the record of ownership. The certificate itself doesn't have to move at all. That's called book entry. No certificates physically move. They're immobilized. By 2001, the Depository Trust and Clearing Corporation handled over $120 trillion worth of cash and securities. That's a lot of stuff that we didn't have to move around, isn't it? The second brilliant idea to resolve the paperwork backlog was multilateral netting. If you sell $1,000 worth of shares in Wendy's to me and you buy $1,000 worth of Starbucks from Diane, then instead of me sending $1,000 to you and you sending $1,000 to Diane, wouldn't it be easier for me just to send $1,000 to Diane and we all call it even? Granted, if we only have 3 players and 2 trades, then we don't save much. But we have thousands of brokers making thousands of trades. Netting allows each brokerage firm to send or receive just one single dollar amount to or from the central counterparty. Most of the time, this reduces the dollar amounts that actually move by well over 90% and as much as 98%. That's a huge reduction in the chance for error, and it saves money too. We've been talking about placing an order to buy or sell shares as if there's only one type of order. The world isn't that simple because people have different needs. You've seen this in other markets. Say you're buying a car. A car dealer might post a standing offer to sell all cars of one particular make and model for $25,000. If anyone offers to buy at this price, then he'll sell. He's posted what's called a limit sell order. If instead you say, I'll take whatever price the market is bearing, then you've placed a market order. But if you think that $25,000 is too much, then you can give the dealer your phone number on your way out the door and tell him you'll buy if it comes down to $24,000. That's a limit buy order. These different types of orders serve different functions. Market participants have developed several different types of buy and sell orders. They give the broker instructions about the timing of an order, acceptable prices, or the duration of the order, how long it lives. Most of their names describe what they mean, so we don't need to memorize much. Each type of order fits a different investing need. The simplest type of order is the market order. That tells your broker to buy or sell at the best available price right now. Usually execution is within minutes, if not seconds. You can't be sure of the price, though, not even if you have your broker on the phone or you're sitting at your computer and you can see the current prices. You might not get your price because the quotes change between the time you place your order and the time it's executed, or maybe because the size of your order doesn't quite match the size of the quote. Size mismatches become more likely as the order size increases. For example, a quote might be for 100 shares at $20 per share. If you want to buy 200 shares, then you might get 100 of them for $20, but you have to pay a few cents more per share for the second 100 shares.